If the tax reform bill goes through, do you plan to increase investment, your company's investment, capital investment? Just a show of hands, the tax reform goes through? Okay.
Why aren't the other hands up?
Why aren't the other hands up?
John, I've got a question for Gary quickly.
This is the residence of Fred Finchley. He's a family man who enjoys the peace and quiet of his little home. Fred Finchley has a good job.
Freddie, look.
And his family enjoys their standard of living. His salary keeps up with the cost of living, and he owns some of those work-saving appliances we all admire so much. Finchley always checks to make sure he gets his money's worth. But after paying his bills, his savings account, and life insurance premiums, there never seems to be enough money left to pay for that. But there's a time for dreaming and a time for working. So every workday morning, Finchley joins the stream of traffic that flows toward his job. As you can see, Finchley could not be called director, but he always gets to work. Right on time.
Hey! Salary $60 a month. Have a cigar. Thanks for the...
Incitement to disaffection is criminal.
Hello, my name is Michael Swanson. I run the website WallStreetWindow.com, and I want to talk with you right now about what we can expect out of the stock market in the year 2019. Now, at this moment, people are making predictions about the stock market everywhere. It's frequently what happens right as you begin the new year. In fact, CNBC just did a poll of every single Wall Street analyst it could get its hand on, and every single one of them declared that they're bullish on the stock market for 2019. Not a single one of them expects lower stock market prices from where we are now. Most of them are projecting gains that will take the S&P 500 over the 3,000 level. So the predictions for gains are everywhere. The problem is you really can't base your investment life on anybody's predictions. For one thing, the Wall Street analysts are almost always bullish on the stock market anyway. They failed to warn us that the market was going to drop in the last 3 months of 2018. They did not warn us in 2008 before the crash happened. I remember that. They didn't do it in the year 2000 either when the internet bubble bust. And I remember that too because I've been trading and investing in these markets now for over 20 years. In fact, for 3 years in 2004 to 7, I co-managed a hedge fund with a business partner of mine. So I know what it's like to also manage people's money. I've seen lots of bull and bear markets. In last year, going into last year, in December 2017, we saw a manic bust in a bull market when Bitcoin collapsed. And there's lessons to be learned from all these things. But I want to tell you that I don't make my decisions based on anybody's predictions, because you have to base decisions on something solid, and somebody simply stating something without telling you what it's based on is a useless thing, really. It's only there to make people read it for enjoyment, not real information. The way to navigate financial markets, I don't care what the market is, whether you're trading the market or investing in the market, is by understanding how trends work and understanding how they change, so when they do change, you can then make the changes necessary to go with the new trends. And what we've seen since September is a trend shift in the market. The bull market that started in 2009 is essentially over. the last 3 months of 2018 represented a stage 3 topping process. And now stocks such as Facebook are dropping. Stocks such as Nvidia are actually in collapse. Even stocks such as Apple are in strong bear trend declines. Now, we have to deal with precision here. When I say a bear market, what is it I mean? You know, because if people talk with you about the financial markets just using slogans without clearly explaining what they're saying, you have to be very careful, especially in moments like this when trends are changing. And we're in a strange psychological moment I'll get to in a second. But what is a bear market? I define a bear market as when stocks or the market itself that's in a bear trend is making lower lows and lower highs essentially every month. Yes, you can have a month or two interruption in that pattern, but the trend is clearly down. And the easiest way to identify that downtrend is by looking at the 200-day moving average in relationship to the price. When you're in a bull market, that 200-day moving average acts as a price resistance. Price support, I should say. Prices trade above it, and when the market falls to it, it bounces above it and hardly ever goes below it for more than 2 weeks at a time. Right now, most stocks in the stock market have been trading below the 200-day moving average for over 2.5 months. The last time that happened was in the fall or towards the end of 2007. That 3-month start of that process marks the beginning of a bear market. It's the completion of a stage 3 top. So we're in a downtrend. We're in a bear market. And the important thing to do is not to try to predict where the stock market is going to finish 2019 at, but to understand and to accept the reality that this is a bear market and adjust and adapt to the reality. I'll talk about that at the end of this video. But you got to understand, we're in a strange psychological moment. And I've seen this before. At the start of every single bear market, when the first drop happens, people feel it, people talk about it, people notice it when they see their account statements. But almost everyone is in denial that anything has changed. You even hear so-called experts blame the drop on news stories that shouldn't be out there. Somehow blame the media for making the stock market fall. So it's fake news. Well, I'm going to tell you something. I know what it's like to have managed a hedge fund, and there's hardly any hedge fund manager or institutional investor that sells stocks based on news stories, much less buys them, but they certainly don't sell them on news stories and get scared like that. Most of the trading in the stock market is dominated by computers. They're certainly not doing that. So that's an excuse and a myth. But regardless, we're in this denial phase in the financial markets. And what's interesting is we also saw something I've seen before, and that's the new paradigm phase. Everybody knows that bear markets happen. And the business cycle happens too, right? With the economy. And they usually have coincide together. When the bear market tops out, doesn't mean there's an immediate recession. I mean, a bull market tops out, typically an economic slowdown and even recession happens 12 months later. And it's just common sense. People know that. But when you are in a manic bull market, there becomes a theme that time is different. That we got seasons of summer when there's good times, and you can think of the stock market, bull market like that. You got fall when the tops and the tip over happens when volatility increases, which is what we've seen the past 90 days, and you get winter in stock markets, and it's the bear market. Everyone knows seasons aren't going away, market cycles aren't going away, but at a manic bull market top, which is what we've seen, you have the creation of a new paradigm that makes people think this time is different. This time there won't be a bear market, or if there will, it'll be 20 years from now or 10 years from now, and I don't ever have to worry about it because I'm going to believe. And people start to think that, hey, I got my job, I want to get out of my job, and all I got to do is hold the stocks, buy more stocks, and I'll just not have to even think about what I'm doing beyond believing, and I'll be able to retire, and my whole life will just be different. All my problems financially will vanish. Just believe in the new paradigm. If you think back to Bitcoin in December 2017, when it was at 20,000, the Bitcoin believers were claiming just that when it came to Bitcoin. They were claiming Bitcoin was something that would go up if the stock market ever fell. They were claiming everyone would be using it by now. Everyone would be using it for money. And by the end of the year, we saw none of that was true. And Bitcoin has collapsed. I'm not saying the stock market is going to collapse as much as Bitcoin did last year. But what I'm saying is that there are just as many, perhaps more people right now who believe that there's some new paradigm for the stock market that's abolished the business cycle or made it so they don't have to even think about it, much like there was manic beliefs about Bitcoin held by so many a year ago. What is the new paradigm? The new paradigm was simple. It was that the tax cuts passed by Congress and by the president. I like tax cuts. I like paying less taxes. But this widespread belief appeared that the tax cuts were going to create this renaissance in the American economy and just create a growth in private business, private industry that would justify the high stock prices that came into 2018 when a year ago from today. And we're going to create this trajectory of higher economic growth that would last for years. And the reality is the tax cuts had an impact, but not the impact that people were expecting. What the tax cuts did first and foremost was help create $1 trillion in stock share buybacks. This is in which corporate America bought their own shares from the stock market floating around out there. That enabled them to lower the amount of shares outstanding and force the stocks up. They spent $1 trillion doing that, a record amount in a single year. And they did this with the extra money they got from the tax cuts, and they did it by borrowing massive amounts of money from banks and issuing bonds. But what they did not do was create a boom in capital investment, a boom in expanding their own businesses, a boom in creating more industrial production and more jobs. And that's why there has not been this huge expansion in economic growth that so many were expecting, and instead the rise in stock market prices accelerated and then petered out when the expected growth did not materialize. The new paradigm did not materialize. And the smartest thing you can do as an investor is, at this moment, is understand that and realize most people are in denial of what's happening in the financial markets still, and get ahead of them before they start to react. As this headline from the Wall Street Journal bears out, the tax cut benefit just was muted in the overall economy. And as an example of this, in the month of November, the Commerce Department reported that durable goods orders rose only 0.8%. And that was following a drop of 4.3% in October. This is hard goods. This is capital investment. And what's disturbing about this stat is this entire 0.8% gain was driven entirely by defense spending. Orders for military aircraft, Wonder jets, nuclear weapons, aircraft carrier maintenance, this kind of thing. If you took that out of the equation, durable goods orders declined again. Industrial construction, expansion, contracted. For the fourth time in 4 months. Just recently, the president approved a Pentagon budget that would boost defense spending up to $750 billion. We're not in any major wars. Looks like we're going to pull out of Syria, draw down in Afghanistan. There's not even 10,000 troops in Afghanistan. We're not in major wars. And yet, defense spending is accelerating at this crazy rate to record levels. Much of this defense spending is going to go to taking nuclear missiles out of the silos, thousands of them, taking them out and putting new ones in. It's a complete waste of money. However, it does create profits for the well-connected companies that got the right lobbyists in Congress who give the right donations. Government spending is going up. It surged 18% last year, while tax revenues only went up by 3 percentage points. This has created a situation in which we're heading for a $1 trillion budget deficit. In the last fiscal year, in the last 2 months of it, the budget deficit was 50% higher than it was in the same period the previous year. This isn't a problem yet, but it's going to be a big problem down the road because this is the biggest budget deficit that the country is going to ever create at a time in which there's no economic recession. So if we're tilting into a recession by the end of this year or in 2020, that $1 trillion deficit is going to explode to levels we haven't seen in our lifetime. That's going to create turmoil in the U.S. financial markets in the future. But that's the future. That's not right now. Right now, the biggest threat that the stock market faces is the fact that it's still in a downtrend. We're having a dead cat bounce, but it'll play out and we're going to go lower because you have to assume that when you're in a bear market because the overall trend is down. I expect we're going to be going lower at least by February. But combine that with the fact that the stock market going into the recent 3-month decline reached the third highest valuation level in its entire history. So stock prices are coming off from an extremely elevated level. They're still elevated in terms of valuation. This chart is the cyclically adjusted PE ratio. You go type that into Google if you want more understanding of it. To save time, I'm just showing it to you. But it surpassed the level of 1929, 2007. The only time higher was the year 2000. But those other 2 times were not good times to continue to hold on to stocks. And the high valuations bring with them the risk of steep stock price losses as a bear market cycle plays out. Over the past 100 years, there's been multiple bear market cycles. The average one has led to loss of 40% and lasted over a year. Now, the bear market of 2007 led to a 57% decline. The one of 2000 led to a 49% decline. And I'm talking about the S&P 500. The NASDAQ, of course, got totally creamed during those last two bear markets. And many of the tech stocks are still more vulnerable to the rest of the market because they also are still posting extremely high and manic valuations. This is why stocks like NVIDIA, even with the recent bounce, are barely able to bounce at all. So what can we take away from all this? We're not in a new paradigm. Economic cycle hasn't been abolished. And we're in a bear market cycle now. And that's not about predicting the future. That's just where we're at now. And bear markets play out over time. And they're not something to be scared of either. Yes, they're scary if you are 100% invested in the stock market and you do absolutely nothing. But they're not scary if you have cash reserves, if you're well diversified, because they're things that actually tend to go up during bear markets. For example, in the year 2000, when the NASDAQ bubble tipped over that April, tobacco stocks began a bull market that lasted for years. Utility stocks began a bull market at the same time that lasted for years. By the end of that year, gold and gold stocks made critical bottoms that led to massive returns for 8 years of outperformance of the Dow and the S&P 500. In 2007, when that process of the stage 3 top in the U.S. stock market was completed, there was another breakaway with gold in the stock market. Also, the Treasury bond market broke away from the stock market, and the U.S. dollar even continued to perform better. Not at every turning point do all these same things go up. Sometimes it's different stuff. But we are seeing some similarities even at this moment in which gold and silver have been firming up against the U.S. stock market since the end of September, outperforming the U.S. stock market. In fact, gold and silver are up while the stock market is down over the last 3 months. I think that's a pattern that's likely to continue going forward. So it's not, the choice isn't I'm fully invested in the stock market or I go 100% into cash and give up on making money from the financial markets at all. It's about reducing risks, finding what can go up in environments like this, and making changes. And I'm here to help you do that now and going forward. If this is the first time you've come to my website, hit one of the blog posts and put in your email address and subscribe to my free update list. If you're watching this on YouTube, go to WallStreetWindow.com, that's the website, and subscribe also to the YouTube channel. That way you'll get my next video as soon as it's released. And
our country is suffering because people like Secretary Clinton have made such bad decisions in terms of our jobs and in terms of what's going on. Now look, we have the worst revival of an economy since the Great Depression. And believe me, we're in a bubble right now. And the only thing that looks good is the stock market. But if you raise interest rates even a little bit, that's going to come crashing down. We are in a big, fat, ugly bubble. And we better be awfully careful.